Welcome back to another episode of Policy and Profits. I am Anthony Esposito of Island Capital. Took the lead today, not getting the big intro from EJ, but my ego will have to make do. EJ and Tony, how are you today? How is DC? And how is the world of policy?
Anthony, another whirlwind week, another data dump, and in terms of policy, we are, my goodness, have things changed to say the least. What a difference an election can make, right? And especially with this last one, it is truly absolutely amazing how many things, some of which we've already talked about, but how many things you thought would like never be on the table in our lifetime, and all of a sudden here we are talking about them.
Yep. 4 weeks in to the Trump administration, and I'll tell you the truth, without even no BS, not kidding around, not goofing around or exaggerating. But I mean, I feel like he's been in office for 2 years already for the second term. There is so much getting done. There's so much movement, so much accomplishment. I mean, I can't. And the Dems going crazy, their hair on fire. You know that he's on the right track, and they're hovering over the target because the louder they get and the crazier they get, the more you know, the more on target they are. It's been very exciting. I love it. We were talking last week to jump into it on about inflation. Eggs have been a major issue, and I'm a huge egg eater, and the whole family here is. So that's been a topic of conversation. The annualized inflation rate for Joe Biden's last report was 5.7%. And then we talked last week about this overlay. Really, absolutely fantastic. We were actually looking at this. Before the turn. A couple of months ago, we had brought this up and talked about it, and now we're kind of a few months into it. So let's dig into this.
Right.
What are we looking at as far as this overlay, just to be very specific, because it really is, it's not identical, but it's definitely rhyming to a large degree to the 1970s.
Yeah, exactly, Anthony. So what we're looking at here is basically just the annual inflation rates from, like you said, late 70s, early 80s versus today. So the dashed line that you see there, that's going back to like mid 1960s, and it goes all the way through 1983 when inflation really came down after Volcker hit us with back-to-back recessions and 20-something% mortgage rates, again, in order to really wring the inflation out of the economy. So that's the dash line, dotted line. The solid line there is also annual inflation rates, but it starts back in 2015.
Mm-hmm.
And what's really amazing is how closely we have followed that previous pattern. Now, obviously, there were different things going on, right? The pandemic and all the spending that followed that versus the issues that were going on in terms of why government was spending money the way it was in the 60s, 70s, right? Vietnam War, Arab oil embargo. Again, totally different geopolitical environment, but nonetheless, it's amazing, as you said, how this has rhymed, right? How the fiscal and monetary mistakes that we've been making today are so incredibly similar to what we did in yesteryear. Also, what's really similar is the fact that after this first spike in inflation, the Fed prematurely declared victory. Now, we can argue about why they did in each instance and how that might be the same or different, whatever the case may be. But you said we talked about this before. I think we showed it on an earlier podcast too. And back then, the blue line, the solid line, had basically bottomed. It hadn't started to tick up yet because this was right before the Fed decided, let's just start cutting rates right before an election. In what I think was just election interference. There's no other way around it. They were trying to get their preferred candidate across the finish line, pure and simple. It didn't work, obviously. But the problem is the cuts that they made then are having an effect now and are going to continue to have an effect well into this year. Now, the difference, I think, between what we had in the late 70s and today is the fact that at this point, it's a difference between Trump and Carter. It's a difference between we need to shrink government or we need to grow government. It's a difference between we just need to print our way out of this or we need some kind of monetary restraint. And which way we're going to go remains to be seen, obviously. But again, radically different public policies that are getting put in place. You mentioned how incredibly fast this administration is moving. I agree with you, Anthony. It does feel like we're 2 years into this thing already because of the speed at which they are moving. So here's hoping they are going to get ahead of this, and this next peak in inflation will hopefully be less than the first one and not much worse.
Yeah. Yeah. So would you say so? I mean, when I look at it, and I think you said something really important. The reasons for the actions, missteps, and steps really are kind of irrelevant. It looks like just human behavior and part of a massive cycle. We're making the same mistakes. We got ourselves into the same hole one way or
Mm-hmm.
the other, and we're making the same mistakes on the way out of the hole one way or the other. Human nature and the decision making has been almost identical, and I can say that I think because the results have been almost identical. But now we're at that spot in the curve or in this chart where it's Carter versus Trump. Would you say that with the Trump policies being put in place and Trump's kind of mantra, and we can see it happening where we are looking to shrink the deficit, we are looking to shrink government, we are looking to create real growth, um, and shrink the deficit and the debt. Those are those, and obviously bring down the 10-year and rates and all the things that come along with improving the environment. Do you think that with the Trump administration in place, the ultimate peak or the second peak here may be a shallower peak or lower peak than the previous, whereas back in the 70s, it actually took out the high and went higher. It seems like Trump is positioning us with his team to maybe have this runoff, and I would expect inflation to continue to spike higher now because we need to work through what's already in the pipeline, and we're seeing that. But can they stop this from being more damaging than it was in the 70s? Like, do we fall short on the second peak?
I think so. My inclination right now, given everything we've seen, is that we are going to have a much smaller peak than the last go around.
Okay.
In other words, we're not going to see a huge spike in inflation where, if we follow the pattern here, it would exceed, it'd be well over 10%, in terms of annual inflation rate. I don't think that's going to happen because the agenda of this administration is so pro growth, pro energy. It is very much anti-inflationary, and I know a lot of people say, "Oh, tariffs are inflationary." No, they're not. By definition, they're not.
Yeah.
It has nothing to do with the money supply. It may make one thing more expensive, but then as people spend money on that, they spend less money on something else that reduces demand elsewhere in the economy, which brings
Yeah.
down prices in those places. It's amazing. The same folks saying, "Oh, Trump's tax cuts are going to cause inflation," are also saying the tariffs, a tax hike, are going to cause inflation.
Yeah.
You can't have it both ways, folks, right? So,
You
I mean,
can't.
again, when I look at this administration's agenda, everything I see points to lower inflation. Look at what they're doing with Doge. I mean, it's absolutely amazing the amount of money that they have been able to find that is being spent poorly, and not only they're able to identify it's being misspent, but they're able to claw it back as well.
Yeah.
That's really meaningful. So we're going to reduce spending, which means reducing the deficit because all marginal spending today is borrowed. So that's going to put downward pressure on the loanable funds market, which will drop the price, which is the interest rate. It also alleviates pressure on the Fed. I mean, the Fed has no reason to monetize the debt if the debt's going down.
Mhm.
Um, Again, everything seems very, very positive. So I think it's just a question then, since everything's moving in the right direction, what's moving in the wrong direction? Momentum,
Mhm.
right? Trump is getting handed an accelerating inflation rate. He's getting handed a $2 trillion and growing deficit, right? A
Yep.
$36 trillion debt where the interest payments are $1.2 trillion a year. So all of the momentum has been going, has us headed in the wrong direction. But Trump and his team are pushing back so strongly in the right direction with those good policies that I think that is going to overcome the momentum and get us our second peak well below, again, the pattern from the 1980s, late 1970s, early 80s.
Yeah, I think that's a good point. The momentum and the pullback to reverse that momentum is the spread that I talk about a lot between the implementation of the new policies, the new administration's policies, and the spread to seeing the effects of those policies. We can't, it's not a hard stop U-turn on many of these things. And inflation is one of them. Consumer debt is another one. Like you have a hurting consumer, you have inflation heading the wrong way, you have rates that are sticky and headed the wrong way. So we have to reverse the momentum and kind of have those things kind of revert to the mean to some degree, but that's going to take some time. And that spread of time, there's pain in there. And there's pain in there. And I think President Trump has been upfront and saying there's going to be some pain, and we have to be ready to handle it. But I think what we want to be conscious of, and there's a balancing act for him and the administration, I think, between looking like you're blaming the previous administration and not moving forward and getting it done. And I think they're doing a good job of balancing those things. There is definitely a ton of damage that's been done. It's a train wreck, to be perfectly honest, in my opinion. But you can talk about it, but you also have to talk about what you're doing to improve it and how you're going to turn that thing around and be upfront with the American people and transparent, which I think they are as far as the timing of it and what the path is. I think this has been, I mean, just the addition of the Doge clock to the national debt clock is insane. It's exactly what we want to see. And honestly, I think President Trump has probably had more time answering questions or in front of the press 20, 30 days in or a month in. He's probably done more than Biden did in a complete 4 years. And it's not only quality, but it's quantity of time, quantity and quality. He's killing it. But we need to be aware that this was a train wreck, and policies will take some time to reverse that momentum, as you said. We talk about a couple of, there are underlying threats, underlying risks, underlying inputs to what we're seeing. And one of them that a lot of people are not talking about, and you posted it yesterday, was on bank reserves. So you have this chart here, and it's running a correlation or an overlay between bank reserves and the S&P 500. What is the correlation historically here? Because this is something I haven't looked at. And we talk about reversion. What is the reversion characteristic here? Why the expectation that either reserves have to catch up or S&Ps have to catch down, whatever the case, S&Ps need to fall to catch, kind of get back in line with reserves, or reserves need to spike back up. Could you go into this a little bit, explain what this is and why they need to kind of revert back towards each other or converge?
Yeah, absolutely, Anthony. Basically, people forget the S&P for several decades now has essentially just tracked inflation, right? The S&P 500. If you adjust it, okay, how do we want to adjust it for inflation, right? Well, why don't you use gold?
Price and
If
gold,
you
yeah.
adjust it using the price of gold, this is something you brought up. I know in an earlier episode, Anthony. You adjust the S&P for the price of gold, and it's flat over the
Mm-hmm.
course of decades now.
Yep.
So, all right. So it turns out the S&P 500 really just tracks the money supply pretty tightly. All right.
Okay.
And one really good way to think of the money supply is to look at bank reserves. It's not that bank reserves are the entirety of the money supply. That's not the point.
Yep.
But the ratio of of bank reserves to the overall money supply over time is a pretty steady number.
Yep.
Right. So that means that since the ratio there, the relationship is basically going to be the same over the long run, you can use that as a proxy for the money supply. And essentially, if the S&P, or I should say, essentially the S&P and bank reserves are also going to track each other fairly well over time. Yes, they can diverge for a bit, but one is going to move to the other, or they can both move towards each other, whatever the case may be. But whenever we get these big discrepancies, what typically happens? Well, again, whichever one made the big move is the one that tends to make the move back in the other direction. So,
Okay.
early, you can see here on the chart, early 21, and then even into, I guess you could say 22, what happens is bank reserves have a huge amount of growth, and it way outpaces the growth in the S&P. And a big reason for that just had to do with the fact that the government kept writing checks to
Mm-hmm.
people and sending them out.
Yep.
And they were all going into people's bank accounts. Yes, a lot of it was getting spent, but then that money is received by someone else and it goes into a bank account over there. So it's still causing bank reserves to absolutely explode. All this government spending, and don't forget the Fed was still cranking the money printer like
Yep.
crazy during
Yep.
2021. So then what happens is once we get into 22, all of a sudden that starts to reverse and bank reserves contract and hard. Now, does the S&P drop? Yes, it does. But bank reserves drop a whole heck of a lot more and basically get back to where they were like a year and a half ago. So it was a huge drop, and we're talking $1 trillion, right? And then you can see in the chart these two things track each other pretty well for a couple of years. But then we get to this interesting point where at the start of 24, at the start of last year,
Mm-hmm.
reserves just are trending down,
Mm-hmm.
except the S&P keeps rocketing up.
Yeah.
And now we've you've mentioned before how the S&P seems to have kind of topped, and bank reserves have also kind of bottomed. Right, they've moved sideways for a few months now.
Yeah.
So the question is, all right, well, which is going to converge back? Even in 21 and 22, where there was a divergence, they were at least moving in the same direction,
Yeah.
right? Both going up, just one going up a lot faster than the other.
Yeah.
But what we've seen over the last year or so is the opposite, where they're moving not at different rates in the same direction, but they're just moving in different directions entirely.
Yeah. Yeah. Interesting. And I would wonder if it makes sense to me. That actually is a great explanation. Thank you. I think, as usual, you have a Z score attached to this thing. I think.
No, no, unfortunately, no. You know what though? That since you bring that up, it's amazing how you can always find certain periods in time, right? Like, okay, take this year or even this 2 or 3 year period,
Mhm.
and you'll get like no correlation whatsoever.
Yeah.
But you stretch this out over a long enough time horizon, and it gets really, really tight.
Yeah. Yeah. I would wonder if, and this is just speculation, but we've talked in the past on the show, and I've talked a lot about it, the massive amount of leverage that we're seeing, the over leverage in the system, whether it's in the S&P futures contracts or with the prime brokers on their interest being paid to them by funds. Numbers are off the charts. Um, the leverage being used could easily be money removed from reserves and then put into the market. But then every dollar in the market could be levered 2 times, 4 times, 10 times or greater to create that run in the S&P, whether through derivatives or through just the cash market. So there's a lot of ways why that $1 out of the reserves could create 10 to 20 to $30 of push up in the market. And I think that's I think it'd be fair to say that that could be part of this massive spread because we're really seeing kind of historical extremes as far as leverage and as far as the exposure being really, really pushed far to the edge of long exposure to an extreme. So that's pretty interesting. And I like the correlation there. That makes perfect sense to me. And the fact that I also love the fact that you're talking about the one that has moved and moved, in this case, hyperbolically away from the relationship is typically the one that will revert and come back, kind of like the prodigal son, the one that runs away, kind of normally the one that comes back. But we'll leave that there. So the next chart that you had up, which I thought was interesting, and this actually, as I say often, I'd really like you to educate me a little bit on this. So you're looking at the reverse repos at the Fed. We know how the Fed balance sheet exploded coming out of COVID, and now on the reverse repos, they've been selling their balance sheet off. Now, could you explain to me exactly what effect that's had? And now that the Fed apparently is getting down to the end of their assets to be sold, are they kind of dwindling down with nothing left to sell? And where does that leave them as far as tools in the toolbox for reverse repos and kind of their management of inflation away from just the Fed funds rate?
So one way, Anthony, to think of the reverse repo market is this is kind of a signal of how oversized the balance sheet is, the Fed's balance sheet is relative to interest rates and relative to the supply and demand of loanable funds in the market right now. So basically, why did we peak, for example, at $2.5 trillion in terms of this facility, at least at the New York Fed desk, right? If you add up across all the regional banks, it was even higher, obviously. But at that point in 2022, that was essentially the amount of excess liquidity that the Fed had created that would have, if it was allowed out into the marketplace, would have pushed interest rates even further below where the Fed wanted them to be, which was an astonishingly low rate at the time, right? I mean, it's amazing how the Fed is having to absorb, $1 trillion or more of liquidity at a time when there is a 1/4 percentage point as the prevailing interest rate. I mean, that's insane.
Mm-hmm.
Um, So again, what this points to is the fact, as this has drawn down, as you can see in the graph, this points to the fact that the Fed selling off the balance sheet is essentially reducing the amount of excess liquidity in the system. Theoretically, when the reverse repo facility gets down all the way down to zero, then there is no excess liquidity left. Right now, all of these different relationships are in balance. Now, that's not to say the whole money market is in balance. That's not to say the loanable funds market is in balance, because the Fed is artificially setting an interest rate. So again, the relationship is just kind of, you just think of it as, okay, given the artificial constraints that the Fed has imposed, where are those constraints relative to these other aspects of the marketplace, right? So
Okay.
again, as the Fed has drawn down its balance sheet in artificial construction, relative to interest rates, another artificial construction, here's how much excess liquidity is left in the system. It's almost gone, right? There's really not a whole lot left here. We're under $100 billion at this point.
So I'm going to pause 1 second. So the excess liquidity, you're marking that as the assets they have on the balance sheet. The reverse repo is they're selling those assets and pulling cash in. So they're taking liquidity from the system back into the Fed and removing that liquidity from the open market.
I would say this is essentially not the amount of excess. Well, I guess, yeah. So you can think of it as the excess assets on their balance sheet, or the excess amount of cash out there relative to the size of the balance sheet, right? So in
Okay.
other words, there's so much liquidity out there that if banks were to, of their own accord, make loans to each other, it would push the interest rate down below where we want it to be.
Okay.
And so this facility is essentially a way for the Fed to say, no, 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 banks, don't lend to each other, lend to us.
Okay.
And it soaks up all that excess liquidity.
Okay.
It's exactly another way to think of it is, this is the same effect as if the Fed did sell assets off their balance sheet.
Okay.
It's just that the way this facility works is it's a short-term loan, like an overnight loan, where the
Okay.
Fed says, "Hey, take this security as collateral. We'll take your cash. We'll give it back to you tomorrow with a small amount of interest."
So they're just really putting a kind of they're kind of funneling or blocking or slowing down the overnight loan bank to bank business by being the borrower of choice, rather than having that money move from bank to bank and be out in the system.
Right, right. So you
Is
got
that
you got
right?
you got Citibank and Wells Fargo, and they're going to make a loan to each other. And there's so much excess cash out there that Citibank, if they want the business, they got a loan to Wells Fargo at 3%. Well, the Fed doesn't want interest rates to go that low, so the Fed steps in and says, "Hey, we'll borrow the money from you, and we'll pay you 4% instead of 3%." Well, the bank, of course, is going to turn around and say, "You got it," because I can get more money borrowing from loaning, I should say, to the Fed
Yeah.
than loaning to one of my fellow bankers. So that dries up the amount of excess liquidity. And now, Wells Fargo has to shop around to somebody else, and they're going to end up having to pay at least what the Fed is paying. So
Okay.
again, it's a way to maintain that interest rate floor.
Okay.
And it points to how much excess money there is out there right now.
But the Fed is losing the ability to do that. They're kind of at a point where they don't have the assets anymore to post as collateral.
It's not that they don't have the assets; it's that they just don't need to
Okay.
anymore. So the excess liquidity just isn't there at this point. A big reason for that has to do
Yeah.
with how Treasury bill issuance has changed, because of two different factors. One of which is that with Scott Bessent in there as the Secretary of the Treasury, he's getting us back to normal debt issuance. Not normal in terms of levels. That's through the roof. He can't control that. But
Hmm.
normal in terms of this, we're no longer going to over rely on Treasury bills. We're going to go back to the normal mix of bills, notes, and bonds. So as we
Okay.
start shifting more and more debt issuance onto the longer end of that maturity schedule, now you have less bills in the system, which they're treated more like cash than other
Okay.
Treasury instruments are, right? Because they don't have that term premium attached to them.
Okay.
So that's happening, and at the same time, you have the debt ceiling biting. So Treasury can't issue more debt anyway. So as old notes and bonds are maturing, or excuse me, sorry, as bills are maturing,
Yeah.
they're not all being replaced with bills. They're increasingly getting replaced with notes and bonds. So as Treasury bill issuance drops, it takes a ton of the pressure off of this facility. So that's why, basically that's the short reason why this hasn't gone to zero yet.
Okay. Okay. All right. Cool. Definitely an education. Thank you very much. There's a lot behind the Fed and how they're managing liquidity and how they're managing inflation and how and what the Fed funds rate is actually, what it actually means and how they think about it. So, all right, good stuff. The next chart, just to get into the profit side of it, I'm going to be perfectly honest now, and I've been writing the note and kind of managing through the market. November, December, January were pretty good months here. Actually, December was the best month I've ever had as far as performance. And the reason is the model was really giving me, I didn't understand why, but it was giving me short signals when everything looked like it was all systems go. And we had a couple of really hard gap downs where we were just really well positioned. We were long vol, we were short the S&P, we were short the Russell, and we made some money there. We made some money in gold along the way after that gold call coming off of 2,600. We are essentially out of gold right now, not because I don't think it can go higher, but just because the stories got very convoluted. I don't truly understand the result of some of what's out there. And the run it's a 15% run, since December. So I'm okay stepping away for now. Gold is definitely always a core holding and always on the radar. But for right now, at the moment, I am completely flat in gold after having kind of ridden this run up from December through this week in the commodity. I think something very interesting has happened over the course of February. We have gotten some really mixed messages. The model for me, I will look at a few different things. I have one official model, which is my momentum trend. I call it motor. And then I have some kind of not anecdotal, but anecdotal models where I look at VIX term structure to kind of see if we're risk on or risk off based on volatility and based on the VIX curve, not just spot VIX. Those models, if you can picture, 5 different arrows pointing 5 different ways every night, that's exactly what I've been looking at for February, and it's been somewhat frustrating. So I kind of zoomed out, and what this is this is the S&P 500 from the COVID low back in 2020 all the way through last night. And I found something pretty interesting. If you look at a Fibonacci retracement and extension from the COVID low in 20 out to the 2022 highs or the late 2021 high, actually, before we took that dip down, Russia invaded Ukraine, the Fed started talking about raising rates, and that led to that move down into 2022. I believe it was June of 22 we bottomed. Those two big lines are that 100% move. And then the red lines in between those two blue lines are the retracement levels for the move down. And then the red lines and the gray line above that top blue line is the extension out. What's really interesting to me is if we take that blue line and that 100% move from the lows in 20 up through 4,600-ish, 4,800 on the top in 21, and then we look at the move down, we retraced 50% down, so you can see that hold on the June 2022 lows. Am I scattered, or are you following me?
No, I'm following you.
Okay.
I'm following you.
And then we took that move down from 4,800 to 3,500, and then we kind of consolidated and moved back through 4,800. So if we take 4,800 minus 3,500, what's that number?
48 minus 35, 13?
1,300. So now if we look at that big consolidation, that big kind of cup from 48 to 3,500, 50% retracement, and we create a measured move out, which would be another 150%, so another 50% retracement above, we take 4,800 and we add 1,300 to it, and we get to 6,100. So S&P cash right now, my point being, is at the moment 6,099. So we're going to call that 6,100 just for fun. We did get up to 6,145, 6,150. That's fine. My point in saying this is, for all the mismanaged arrows and misdirections and the craziness in the model that I'm looking at, we are at all-time highs with a lot of volatility, a lack of conviction, and what I've talked about as a formation that looks like a top versus a continuation out. As I run this regression and projection, there's a couple of things that stick out. We're at the 50% projection line out of the top of the previous move. And that 50% projection line matches perfectly with a very nice cup-like consolidation between 4,800 and 3,500 as a measured move up. So all roads lead to 6,100. I do believe 6,100 will act as give or take. So we were a little above, that's fine. But I do believe the 6,100 level will act as significant resistance here. And if we look down at the lower part of the chart, it's a basic MACD for a basic momentum kind of indicator. The weekly indicator for momentum has been negative. It looks like it's improving a bit to try and turn positive. But if we see that downshift on the weekly and the weekly fade at the 50% retracement, these are all kind of clues as to maybe we should be cautious here, and I remain cautious here. Even though my daily has been positive and we've gotten a positive move, and even though the VIX, one of the VIX anecdotal models has been risk on for 16 days now, that's about run its course. That's got another 7 days to go, 5 days to go. We kind of can make a case for remove some confusion, zoom out to the weekly. What have we seen on this entire move? So COVID lows, we had that big run out. We had that bear down. We kind of consolidated, now a big run out. We're still at that 50% retracement level. I believe it's a good spot to say we're going to watch this level and make sure we're breaking out with improving and positive momentum, or else I think that we're going to fail at this level. Now, where does that failure bring us? I think the 6,100 level could definitely ultimately bring us down towards 5,000. I have no doubt that that could happen. But initially, I think 57 to 5,800 is a very reasonable target for a reset for the market, for the S&P cash from the current 6,100 level. That's kind of the run. That's kind of a zoomed out, different way of looking at this with retracement levels, projection levels. It all kind of rhymes and makes sense. And I just wanted to point that out.
It's absolutely fascinating, Anthony. So I guess going forward, you know, are what are the things that you might see on a daily basis, or maybe weekly basis, whatever the case may be. But what are some indicators that you're looking for in the days ahead to try to give you some clarity in terms of which way you think things are going to go, or maybe another way to put that is, what are the inputs that ultimately are going to cause the model to more consistently point one direction or another? Like, is there anything in particular that would really shift it in terms of the direction?
We would need to see a consistent momentum growth and trend growth. So I have different indicators that I use in combination, and I like them. I need them to confirm or diverge for me to have a positive or a negative signal. And when we're kind of like in the middle where there's some confirmation and there's some divergence, that's my neutral call. So that's been something that I've just developed over time. I'm looking for those signals to start to confirm. I'm also looking for spot VIX to be either muted or risk on, and that's a totally different model. And then I look at the slope of the VIX term structure. So the slope of that curve for me determines whether we're essentially should be short VIX, neutral on VIX, and by VIX I mean front month, second month futures, or long VIX. So as we're short VIX based on curve structure and slope, which would be contango, you would be short VIX, which is essentially risk on in equities, and then we have a neutral period based on slope, and then we go into backwardation, which would be long VIX and short equities. So I'm looking for the volatility indicators I look at to start to confirm and be consistent. And I'm looking for the model and all of its inputs to kind of line up. So think of them as, you have 5 kindergartners in a class. When they get in line nice and they walk towards the ice cream bar, everything's cool and you're heading. When they get in line nice and they walk back to the bathroom because they just had ice cream, you know you're cool. Everything's kind of moving in the right direction. But when they're scattered around, shirts are off, shoes are flying, you know, they're drawing on each other with crayons and markers and stuff, then you're like, I don't know what to do, so I'm neutral. I'm the teacher. I'm going to sit at the desk and just wait for them to get tired, drop, and fall asleep. So that's kind of where we're at. However, when they get to the ice cream bar, if they start drawing on each other, throwing their shoes off and kind of going crazy, that's kind of where we've been at. They're where they want to be, but they can't hold it together. That's a problem. That's a little chaotic for me. And at all-time highs, you know, when kids are getting drawn on with crayons, I kind of sit back and say this is a neutral call. So those are the signals. My 5 kindergartners are my signals. They're not confirming. They're running all over the place, and they can't get it together. So with that, these moves have been very frustrating for me. I have made very good money over the past few months, but it's just been a lot harder than it needs to be. And I don't like that. I like when it's kind of it's uniform, it sticks to the model, it sticks to the routine. And when it breaks, it's fine. I can step away. But the constant chaos here has just been it's been concerning. Ultimately, I think it resolves itself to the downside. So every time we tick up 20 bips or 70 bips or 1%, you know, I think it looks like I'm kind of not sure what's going on. I'm sure what's going on, but I'm not going to jump in for a 1% move up when I believe, based on what I'm seeing, that there's a 5 to 10% move down coming very quickly.
How much of the chaos stems from all of the speculation on the policy side of things that you're seeing, right? Where, I mean, it's like, you know, look, we love President Trump, but it's amazing how every time he gets up to a microphone, I mean, markets either take off on a rocket or they nosedive. You know, and whether those responses are justified or not, that's just kind of the reality of the situation, right? So, I mean, how much of that volatility, for lack of a better word, but how much of the craziness that you've been seeing is simply due to the policy side, or I should say, all the speculation surrounding the policy side of what the heck's going to happen next?
It all plays in, and it plays in perfectly. And it is volatility, not in implied vol in options or the VIX in term structure necessarily, but it's just price volatility. Like the emotion and the buttons getting hit, the stops going off, they all affect price. They all affect where we open and close. And with that, and the size of the bars and the moves, that all contributes to the model. So, you know, if he comes out on a Sunday night and says, I'm slapping 25% tariffs on Canada and Mexico, and China, you're next, and Xi comes out and says, we're going to retaliate with tariffs, and in the overnight, you know, we're down 2%, or we have a deep seek issue where we're down 3% overnight and then trying to recover there. It all plays into the model, and it does all play into the confusion. I had said this, we were at that USOGA meeting 2 weeks ago.
Mm-hmm.
And, you know, I love President Trump, but he's making my overnights very difficult because I don't know, you know, there's a comment out on a Sunday, and, you know, I'm down here at 6. I go back up to bed at, you know, maybe 10:30. And then at midnight, my wife's looking at me like, all right, so I'll see you tomorrow. And I'm out of bed and down at on the desk for the day, or heading out to meet with an investor, or heading out to meet with a trader. So it's definitely, it's an issue. It's contributing to the volatility. But over time, these things aren't new, right? There's always issues. There's always road bumps. There's always tape bombs. You know, President Trump is the king of them at the moment, and typically. But, you know, over time, the model works because you don't look at 1 year or 1 month or, you know, 2 years. You look at a model and how it has performed over 10 years, over 20 years, over 30 years, over 40 years. Like, does it actually work? And does it work in practice? And the answer is it works in practice. It just gets, you know, sometimes more frustrating than others. And it tries your patience at times where you need to be able to say, as a manager, I don't know. I'm going to step back. I'm going to let all the children fall asleep on the mat. And when they wake up, I'll try and get them back in line.
I love that analogy. Absolutely love it.
I just thought
Absolutely
of that.
love
That was
it. You know, kindergarten, right? That's the what you're gonna you know it better than I do. What's the Nate Bargatze line with kindergarten? You know, oh, is that the first grade? No, first
good.
grade is a different thing.
No, the second year is actually first grade.
Yeah, that's right. That's right.
Oh, you know what? I think we have that. Hold on 1 second.
For in our great nation, we will create schools to teach our children our ways. The first year of school will be called kindergarten.
And what will the second year be called?
First grade. There will be 12 grades in all.
Ah, so a dozen grades.
No. We don't use it that way. But the children will not have to go to school every day. We will have our own holidays, 4th of July, Flag Day, and President's Day.
And what shall we do to honor our leaders on President's Day, sir?
Buy a mattress, of course.
Of course. Just makes sense.
I actually did that
His
last
deadpan's
President's Day.
That's guilty as charged too. That makes two of us.
Oh my God. Listen, man, in the midst of the chaos, we got to laugh a little bit. Definitely exciting times, and definitely appreciate the time, EJ. Have a great week, and I'll catch you next week.
Always a pleasure, Anthony. Great to be with you.